Investment skill and market management are two of the most common measures that people use for a successful retirement. They aren't necessarily things you can quote unquote control, but they are things you have the ability to adjust. And obviously this is where a skill set comes into play and where you want to hire qualified advisors and money managers to be able to help and assist that. What you can't necessarily control in the walk of life is the actual market timing that occurs. Now, I don't mean when you buy or sell a stock. What I'm referring to here is the market in a secular bull, meaning that it's rising, or a secular bear, meaning that the market is declining. Because it really does make a huge difference in terms of how your financial journey is going to look. Good morning and welcome to Consider This Program. I'm your host, Joe Clark.
And I'm Adam Harter.
So happy to have you along. Hey, we are going to talk about savings and then distributions and what it means. So what's a distribution? Well, distribution is when you actually go to take the money out. I'm in the middle of writing my book. It will be out later this year. They think it's going to hit in October. But it really is about what distribution looks like, what it means emotionally for people in terms of how it's coming out. Here's the thing I need you to understand. Your retirement dollars will exit. They will exit. They're either going to exit by your choice, they're going to exit by the choice of somebody else, they're going to exit by the choice of the IRS with the words required minimum distribution attached, or they're going to come out when your heirs have the responsibility for it. One way or the other, the money that you saved and accumulated is going to distribute. It is going to come out. Now, when we look at your life, when we look at your financial journey, what we have to discuss is what market timing really looks like. Now, Adam, when we say market timing, people are going, oh my, somebody thinks they can time the market. That's not what we're talking about. What is it? What's market timing in this case?
In this case, I go to the word luck, and there's no way around it. Luck is going to be a part. You and I are big readers, and one of the, I know because we've talked about it so many times, the books that we've enjoyed more than any others is Outliers by Malcolm Gladwell.
Oh, absolutely.
And the role that luck played in some of the world's prominent people had to do with their situation, where they were planted, when, not only where, but when they were planted. And that also happens to the investment portfolio. The results will have to do with your discipline, with your skill. Like it or not, though, it also will have to do with when you start saving and when you start withdrawing. And there's no way around that. You just have to be aware that is a piece. But you can draw on lessons from history and how to manage around when you're dealt the bad hand of poor timing.
So it's fair to say that the inverse is really true. If you're beginning to save, you would really like a declining market. If you're beginning to withdraw, you really want an inclining market. Is that fair?
Yeah, luck goes both ways.
Right? Absolutely. You can't control when you're born, right? And you can't wait to 30 to save just because you think you're in a bad market, right?
Absolutely.
And you can't tell your employer at 65, I think I'm going to stick around until 70 because things don't look too stable right now. That doesn't work for everybody, right?
Absolutely.
There's things you can't control. So let's go to one of the greatest economic catastrophes of all time, Japan. So why don't you walk through your version of what happened in Japan, and I'll add a little bit.
Oh, no, I think Japan is going to be one of the 5 all-time bubbles up to this point in time. Bitcoin is rapidly becoming a 5th, perhaps. But you have the dot-com, people here in the United States know, is one of the all-time bubbles where prices and stocks escalated to the moon and came back down. Gold in the late 70s, early 80s, some of you will remember. The Nikkei, the Japanese market, is another one.
And let's not forget the tulips.
And the tulip mania, right. Yes,
so
several centuries
ago. That probably covers most of them. Of the big ones in history that we know about.
Yeah, and so the Japanese stocks, we had many stories in the 1980s about the Japanese economy being really strong, perhaps overtaking the United States. A lot of that had to do with their soaring stock market because of the wealth that it generated. But it was a really strong market in the 80s, but in the late 80s, it really started to take on another layer and eventually topped out in the early 1990s where Japanese stocks were trading at 1,000 times earnings. Now, what does that mean in reference? So when our stocks in the dot-com era also began to take on high price to earnings ratios, that ratio will measure just how lofty prices were. We were nowhere near that.
No.
You had a few isolated stocks here and there, but 1,000 is many magnitude, and investors paid the price from that point in time on.
Especially when you're talking about an entire market. So what happened? One of the things that we teach our team in the planning and the allocation team is that markets tend to take escalators up and then tend to take elevators down, meaning they drop much more rapidly than they rise. In Japan, it was one of those periods of time that's very, very similar to the late 1999, if you will. 97 and 98 had a little bit of volatility in the tech wreck. But the escalator up, right, and then the elevator down starting March 10th of 2000 was just, unprecedented in terms of what happened to people. So Japan had two things that were working simultaneously, which is why we talked about the housing market earlier. And remember, if you missed something on this show this week, you can always go to our website at yourlifeafterwork.com. The links are there to be able to get to the other segments that Adam and I talked about. We have 4 segments that we're discussing this week, all about what goes up must come down. We've talked about drawdowns, savings, interest rates, and the housing market. 4 very interesting topics, I think, for people. But the housing was phenomenal. And so there used to be an old saying, and you're younger than I am, so you may not remember this, but the saying was that back in 2005 and 2006, people would tell you that the price of housing never goes down, just ask Japan. And, and I know what happened in 1991. In 1991, Japan actually introduced the first 100-year mortgage. Right? You could put 3 generations into debt. By the way, you can't do that in the United States. You can put you in debt. You can't put your heirs in debt. We do not have 100-year mortgages. So it's just kind of a crazy thing. So for those of you that are watching the video, we actually have a slide. So Adam's going to walk through this slide for you so you can see what's happened in Japan. Again, if you're listening on the radio, you can go to our website at yourlifeafterwork.com, click on the link where we're talking about savings, then distribution, and you'll be able to see what we're talking about. But this really is the history of the Nikkei in the Japanese market. So think S&P 500, except you're dealing with 225 stocks in Japan. So Adam, what are they seeing up there on that chart?
Yeah, so what you're seeing there is if you're going back into the late 70s, it was a strong market, and it began to take off in the 80s. That was when you had the Japanese domination. But then it really, in the late 80s, just took on the whole new meaning. And so you see the price on the Nikkei surge there into January 3rd of 1990, and then it set a high that we've not seen ever since. And we saw some collapses.
Still haven't. 30 years later, folks. 30 years later.
Yeah. And so there was a couple lows. 2003, it ultimately formed a bottom. When we had our crisis here in 2008, it was a global crisis, and the Japanese participated. So you see those 2 low points on the chart. And then you've seen a recovery basically ever since. And every time the Japanese market would have a good year or 2, you would then look back and say, yeah, but it's still 10,000, 20,000, 30,000 points shy of where it's all-time high. But now we've seen a really strong move, and it's still a little bit ways off from that all-time high. And so if you were a person who just put a flat amount on that day on the high, you're still waiting to get back to break even.
So 3 points I want to make here, and hopefully I'll be able to remember them without notes. The first one is, remember, bear markets, which is clearly what you're seeing in that chart. Right, the absolute destruction of a market. Bear markets are sometimes the best for short-term trading. I have a chart that I show people when we're having meetings sometimes that shows some of the best investing that ever occurred was between 1932 and 1934. You had a 70% rise in the market twice. You just also had matching falls, right? So if you were able to get in and identify what was going on, you had the ability to be able to get out. That's why Andrew Thrasher, by the way, is part of our team. That's where that technical allocation comes into play, and that's I will just tell you that's how my Roth IRAs are managed, is under that technical aspect because of the craziness of where we are in the market. But the second part of this is really understanding the differences that happen. So Adam, when I look at this chart, if I was going to be somebody who was going through the accumulation phase, right? So we tell people there's 3 phases of finance: accumulation. Ultimately, you have enough money that you're now preserving, more importantly, than adding to what you have. And eventually you have to go into distribution. So looking at that chart, which one of those would I want to be in? Where would I want to begin if I was going into accumulation?
So I'm sure you could find many places in the early 70s that might not be such a bad place to start because you had such a strong market to lift it. However, the most ironic or the counterintuitive place for me is I go right to the top. right in that 1990, because you started out with how much? Zero.
Right.
You're starting out with nothing before the crash. So each time that market drops a little bit more, your monthly deposit is buying a little bit at a lower rate, at a lower rate, at a lower rate. And now that we've seen it recovering for the better part of a few years and now surging, that's happening on the backs of a bigger balance. You were taking that dive on a much smaller pool. Well, now, and this is where that luck comes into play. Had to be really hard and really difficult to see you put money to work and watch it fall, put more money to work and watch it fall. But if you kept at it, kept disciplined, it eventually worked out into your favor. So yeah, you go right to that top with a zero balance. Would have been a heck of a place to start your accumulation.
And the worst place to start distribution.
Absolutely.
Yeah, you wouldn't want to be there. So there's a point Adam and I have to make while we're here, and I've been, the Market Carver actually started in 2007. That was the first time I did one up in my Lafayette office. We still have that office up there. It was right before I started teaching at Purdue and technology was available. And one of the things that I tried to make very, very clear is there is a phenomenal difference between the economy and the market. The stock market and the economy are two separate beings. They may tell you that they correlate. They may teach you that in school. I'm telling you, short term, it sure doesn't happen. So what I want you to understand is until probably, 10 years ago, Adam, Japan was still the second largest economy on the planet, right? United States is number one by far and away. China finally, replaced Japan. Japan's still number three. Right? And so when you look at that chart, that the fact that they're 30 years later and their stock market is still not back to where it was, understand their economy is actually stronger today than where it was then. There is a difference between the economy and the stock market. We get calls every single week saying, hey, has this market run its toll? I'm worried about the economy. When I used to do CNBC, Maria Bartiromo and other people would ask me, they would ask about unemployment, and then when they ask me the question about the market. And I would always try to remind them those are two separate things. And that's what I want to try to remind you today. They're two separate things. Adam and I get paid as fiduciaries to treat your money as if it were our money and we were in the same situation. And though we closely watch and study the economy, we know how important it is. We know how important it is to the families that we take care of. What we get paid to manage and what your retirement is based on is not the overall economy. It's what happens in that portfolio. It's what happens to your nest egg. And as fiduciaries, that's where we really come into play. So again, if you want to do this on your own, that's your business. But if you're looking for a fiduciary, that really is our business. Give us a call at 800-928-4001 or go to yourlifeafterwork.com. We look forward to sitting down with you and spending some time.